Coming off the back of a week that saw major disinflation in the UK, we saw the ECB cutting interest rates by 25 basis points, and we saw major volatility around big tech names after ASML and TSMC earnings. Well, we've got a new week, and so let's take a look at what the key events are for the week starting Monday, the 21st of October. So here are the big ticket items for the week. Certainly, according to Trading Economics, there's not that much to get stuck into. According to this chart, you can see just 5 events and 2 of them in terms of the Canadian rate decision on Wednesday, essentially just the same event, really. So what are we going to see? Well, we're seeing a whole host of PMI data coming out on Thursday. And so whilst they've highlighted the German figure in terms of manufacturing, we have got plenty to sink our teeth into on Thursday in particular. Also got a US theme on Friday. And certainly the US really is in focus at the back end of the week. But the big event for the week is likely to be that interest rate decision from the Bank of Canada. According to Trading Economics, we're expecting to see a 25 basis point cut. This would be the 4th consecutive rate cut from the BoC. Whether we see 25 or whether we see 50 could be notable. You know, if we're looking at what else there is over the course of the week, we have got PPI on Tuesday, where there's an expectation that we see improvement with that year-on-year figure actually bumping up to 1.1. That clearly down to base effects. The month-on-month figure still down minus 0.7 on a month-on-month basis. So not necessarily seeing major upside in terms of this figure as things stand. Then if we're looking in terms of the likes of the Bank of Canada rate decision, well, how is that shaping up? I mean, the fact of the matter is that when you're looking at Trading Economics, it says one thing. When you're looking at Icon or the London Stock Exchange platform, you can see that there's an expectation that we cut down to 3.75, a 92% chance of that happening. So there's a disparity in terms of what you're seeing from different platforms. Certainly, there is a feeling that we will see them cut, but the size of that cut is going to be key, and the expectations going forward is going to be key. I thought the interesting chart to be looking out for on this one is going to be the US dollar against the Canadian dollar. And so I just wanted to throw that up here. And so this is dollar CAD, right? So what we can see here on the weekly time frame is that we've seen this bumper period, this rebound following this retracement. So we've got this symmetrical, well, not symmetrical, we've got an ascending triangle. I would say it's ascending. I mean, we've essentially got flatlining tops, but the top end is more of a zone than a single level. I have drawn on this one single level of 1.386. But nonetheless, we're coming into this resistance zone that, as you can see over the course of 2023, 2024, and some of 2022, we have respected this area. So time and time again, you know, 1, 2, 3, 4, 5 times we've tried to break through this zone and try and get up through the 140 mark. It has not happened. So we could see further upside for the near term, but certainly whilst the trend is bullish, we're coming into an area that historically has always seen this market falter. The near-term price action shows you this nice double bottom formation with the breakout taking us on that sort of straight line move towards the upside. This comes during a period of strength for the US dollar in particular, and also a time of weakness for energy markets. And we do have that correlation between the Canadian dollar and oil prices. But nonetheless, what we're looking at here is a rally that clearly can be traded over the near term, but ultimately you have the fears of a potential sort of topping out of this pair as you come closer to that resistance zone. So we've seen this pullback. If we see a break up through your near-term swing high that has just recently been established at 138.38, then that points towards a continuation of this recent rally. But as we get closer to this area of resistance, so you have the possibility of it rolling over. Of course, as we move towards the election, the question mark is of whether we're going to see greater upside in terms of the US dollar. I would expect that to happen. Now, what we've seen is strength in terms of equity markets, but that comes at the same time as strength for the US dollar. And for me, it's playing out like this, right? Typically, the fallout from a US election generally is relatively bullish as you see that moving out the way. So we're seeing people sort of front running that move, but you're also seeing the sort of caution playing in relation to the US dollar. When we look at what's happening in terms of the US economy, we don't necessarily have the basis for sort of 50 basis point cut because we saw a relatively strong jobs report in the US. And so that also lifted the US dollar. So I think there's a good chance we still do see further upside for the US dollar, and certainly a breakup through this latest swing high that we have here at 138.38 would point towards a continuation of that. It's just worthwhile bearing in mind that once we get through this 138.62 zone or level, you come into this zone that historically has marked top. So it's worthwhile looking at intraday price action to see whether we see that happening, or whether we don't, quite frankly. You know, at some point it looks likely to break because the trend very much does point towards a bullish breakout rather than a bearish reversal. It's just, you know, you're talking about like 2 years, 3 years in this chart. And so there's no guarantee it's going to happen immediately. Next up, we're going to talk about the US. So we already have talked about it a little bit there, but certainly the economics within the US are going to be absolutely key as we try to gauge exactly what the pathway is for interest rates in the United States and for the Federal Reserve. Key amongst those this week will be the PMI figures on Thursday. Generally, PMIs give us a leading indicator of how the economy is doing. And really, you can see that the US has this massive disparity between the health of the manufacturing sector and health of the services sector. And this is something that I think is really interesting at the moment, because when you're looking at the sort of prospect of Donald Trump coming in, much of this idea of, you know, he's going to be pro-business is all about manufacturing, right? It's about producers. It's about businesses bringing their factories into the US. It's not necessarily so much about the services sector, but it's the services sector which leads the way. And it is the mainstay of the economy, really. But really, if you look here, 55.2 in terms of the latest services PMI figure, well, the composite reading is at 54.0. So really, the drag of the manufacturing sector is minimal, despite that is heavily below that 50 threshold. There's an expectation that we see the two narrow, 55 on the services, 47.6 in terms of manufacturing. But certainly, if you see a theme, right, if you see all of them moving better than expected or worse than expected, that's going to give you an idea of what you think the Federal Reserve might do. And certainly if we see stronger economic data, whether it's weak jobless claims, whether it's higher PMI numbers, whether it's stronger core durable goods numbers, all of that feeds into the idea that the Federal Reserve has no reason to cut by 50 basis points, and they're going to be able to take a little bit more of a slow approach. And certainly that does seem quite likely as things stand. Now, here's the breakdown in terms of those PMI numbers. You can see here at 54 on the composite reading, the US really leading its peers that I've included in this chart. The UK also standing a relatively good stead at 52.6. Australia, Eurozone, Canada, all below that 50 threshold, all in supposed contraction territory. It doesn't necessarily always translate into a recession, so to speak, because that needs to play out over a prolonged period of time. But nonetheless, it gives you a good idea of the direction of travel for the economy, and the strength of the US economy does point towards a more cautious approach from the Federal Reserve going forward. Well, what's the market expectations as things stand? There's a 92% chance that we see a cut in November, 75% chance that we see a second cut in December. And then it starts to get a little bit more wishy-washy, right? January, only a coin toss for another rate cut, 53% chance of another 25 basis point cut. It's a similar kind of story for March. So once we get into 2025, there's a lot more uncertainty about the path for interest rates. Are we going to see a cut at every meeting or not, right? And so right now we're in a position where markets aren't necessarily super confident into next year, and data will inform us, right? We start to see a deterioration in terms of this data. You're likely to see pricing for these further out meetings, which aren't that far away, change, right? So if we see weak PMIs, if we see a spike in terms of jobless claims, if we see weak durable goods orders, that's the kind of thing that could impact expectations, in particular around your January and your March, which at the moment there's not necessarily a huge amount of conviction for one way or another as to whether they're going to cut rates or not. And so from a market perspective, if we bring up the S&P 500, which is here, we can see that right now things look relatively strong, right? I mean, you know, the weekly time frame looks like this. It just continues to move up and up and up, right? So you've got a very clear-cut trend, and then you're looking at the near-term intraday chart. What have we got? Well, we've got this bullish trend, but we do see periods of consolidation, periods of retracement, once again here coming into trendline support, and that's exactly how we're ending the week. We're coming into this 76.4 fib. We tagged the trendline support, and we're moving towards the upside. So I would say the trend is your friend. Always rely on price action first and foremost. You know, it's all well and good trying to guess exactly what the numbers might come out like, how markets might take it. But the most important thing is how it's being traded, right? And so this chart continues to look bullish as things stand. We've pulled back into this nice retracement, and now we're up on our way once again. And the 15-minute chart should give you a much more granular view on that, right? Here's the retracement. And then once we broke up through your swing high, then we start moving into higher highs, higher lows. So I'm expecting to see more bullish price action playing out. Next week, we continue to see earnings. Tesla heads up those. And I've provided a preview in terms of the earnings to look out for over the course of the coming week. But certainly it's, you know, it's going to be a number of different things really feeding into market sentiment at the moment, earnings season, economic data and monetary policy expectations, politics and what's happening in the Middle East and the impact on energy prices and inflation expectations, and then the US election, right? So there's a lot going on at the moment, but like I said, everything's distilled into price, and price remains bullish at the moment. This pullback into support and the rebound up through that intraday high on the near-term 15-minute chart does, to me, point towards a strong end to this week and likely strong beginning to the week as we come into it. And certainly the data that we see coming out of the US should inform us better where we see a potential for, you know, a little bit of weakness, possibly providing strength. Now, we're in an interesting time as to whether good news is good news or good news is bad news for markets. And I would say that, you know, good news is good news unless it's too good, right? We don't want to see the good news, you know, the economic data so good that it starts to unwind expectations in terms of rate cuts, and it also starts to lift expectations in terms of inflation. And finally, let's talk about the UK. We have a couple of things on this calendar that aren't on this calendar, right? And that is a couple of appearances from Andrew Bailey at the Bank of England. I'm just trying to bring up exactly when they are. Here we go. So Tuesday at 2:25 UK time, then Wednesday at 9:30 p.m. UK time, and then on Saturday, which is 26th at 4:20. So Andrew Bailey's going to be making plenty of appearances. That comes off the back of a week just gone that has seen downside in terms of the unemployment rate, downside in terms of average hourly earnings. We've seen a massive decline in terms of inflation. We did see a slightly better retail sales than expected, but nonetheless, you know, all of it points towards stronger economics, weaker inflation. That's a good spot to be in, right? It's the soft landing spot where you see an economy that's not rolling over, but also the inflation picture pointing towards a possibility that the central bank can take whatever action they deem necessary. And so we look for more of the same, right? So you're looking at the composite PMI on Thursday, expected to tick up to 53 from 52.6. PMI expected to improve. Services expect to improve. Improvement expected in terms of consumer confidence. So let's see if we can remain within this sweet spot of strong enough economy, but also sharp declines in terms of inflation, which points towards the Bank of England being able to cut at each meeting as we go forward. Here's the outlook for the Bank of England. 86% chance of a cut in November, 74% chance that we then see another one at the meeting beyond that. And again, we see this indecision coming into 2025. 46% chance of a third consecutive cut, or a third cut in February and in March. Again, another sort of coin toss at 52%. And then it sort of stabilizes out at 4%. Now, I don't expect to see the terminal rate essentially around 3.75 or 4%. It's just the markets at the moment are trying to ascertain exactly where we stand. And so that's why this economic data is going to be particularly interesting. Here is the final chart I wanted to show you, and it is sterling against the Swiss franc. Let me just bring it up here. So weekly time frame looks like this, right? So you could say that the trend is ultimately bearish. But if we look at the price action over the course of 2023 and 2024, you can see it's not necessarily been that convincing. But I would say what is quite convincing is what's happening over the near term, because what we've seen is this sharp pullback, and then we've been sort of regaining lost ground. Now, we've pulled back into this retracement. And then what I like is that we've got what looks like a retracement followed by what looks like a bottoming out. And then we can look at it on, say, an intraday basis and say, all right, well, we've got this lower highs and lower lows now creating higher highs and higher lows. And it's really clear cut. I mean, you know, that is very clear cut and clean and similar on the way up. We have got the possibility that we pull back at some point in terms of sterling Swissy. But certainly if we pull back, there's a good chance that the bulls come back into play once again to continue this sort of exit following this retracement and a potential push up towards a sort of 1.14 kind of area. But certainly relatively clear cut at the moment in terms of the deep retracement and the reversal of lower highs and lower lows into higher highs and higher lows. Good chance, like I said, that we do see a pullback in the near term. But it's an interesting one to follow. And in particular, if we see strong economics coming out of the UK, that could feed into this narrative for sterling Swissy. I hope that's been useful. Like I said, there's plenty feeding into markets at the moment, whether it's the earnings, whether it's Middle East concerns and energy prices, the economics, as we've been discussing today, or the US election, which we will be providing plenty of coverage at here at Scope Markets. All of it feeds into a market that is particularly interesting at the moment. But like I said, the most important thing is price. So follow what price does over everything else. Thanks a lot, and we'll join you next time. Thank you.